Thank you so much for having me today. I'm very, very happy to be here. I want to thank, in particular, all my colleagues from the World Gold Council, as well as our partners from Tsinghua University and the China Gold Association for having me today. It's been, like Michelle said, more than 3 years since I've been to Shanghai, so it's great to be back. I'm really glad to see a full room of people that are looking to learn more about gold and technology and foreign reserves and everything else. So over the next 20 minutes or so, I want to talk to you about a particular topic that has been catching the attention of investors, policymakers, and the general public more in general, which is activity in the central bank sector on gold. So with that, I'm going to start a presentation. I want to talk to you about 3 things in particular. First, I just want to give you a perspective of what has happened in the gold market in general, and very much specifically in central banks so far this year. I also want to talk to you about why central banks want to include gold in their reserves. We heard earlier from Mr. Ding that renminbi is an important part of foreign reserves, or has become, or is becoming slightly more important, and there's a view to increase that. So I also want to talk to you about how gold fits within that picture. And then finally, I also want to tell you about our central bank survey and the results from that, which it's a survey that we conduct once a year, and it gives us and you as well a very good perspective of what central banks, or how central banks think about gold and or other assets within foreign reserves. Let's start talking about central bank trends first. So far this year, in 2023, gold demand has been slightly above trend. So gold demand has been quite robust. Not in small part by net central bank buying, which remains at a record pace, as I will discuss in more detail in a minute. Jewelry fabrication has also been steady, and part of the contribution from that comes from Chinese consumers. Bar and coin demand has been stable, and this is interesting because bar and coin demand has been weakening in Western markets, and very much specifically in Europe. But that has been softened by growth not only in places like Turkey, but also as well in China. Now, on the flip side, generally speaking at a global level, gold-backed ETFs have seen a decrease in assets, except, again, in China, so which is really interesting. On the supply side, both mine production and recycling have increased so far. Now, let's dive slightly deeper into central bank demand. Central banks in general have been buying for more than a decade. This year will be the 14th consecutive year of central bank buying. And over the past couple of years, or specifically last year, we saw a record amount of demand coming from central banks. And so far this year, we are also reaching a fairly strong pace, almost a similar pace to what we have seen last year. The last bar on this chart, which is slightly lighter, if you can see the difference in tone, is the year-to-date as of Q3 demand. So you can see that actually, if the pace continues through Q4, then we will be at a very similar level to what we were last year. And this is important because, number one, this is not a completely new trend. As I was saying, this has been happening for more than 10 years, and I'll talk about the reasons why in a minute. But the other thing is that it has been accelerating, and there are many factors why this is happening. In 2023, some of the central banks that stand out have been China, perhaps not surprising, hopefully, just to many of you that may have seen reports from PBOC directly about gold buying and adding gold to their reserves. But we have also seen central banks like Poland or Singapore or Libya or India also increasing their gold reserves. So it is not a phenomenon that is only appearing in, for example, Asia, but more generally around the world. And even though, for example, on the flip side, we have seen some net sales, most notably from Turkey, those were very specifically driven by the use of foreign reserves, gold reserves, by Turkey at the beginning of the year. But actually, they have been increasing the reserves again, putting back gold into their coffers after having been using gold to defend the lira. So gold is a very useful asset to many central banks. Now, central bank demand, there are various sources that we use and we rely on to give you a perspective of what is happening across official institutions. Some of them come directly from the IMF, and as central banks report to their monetary gold. But there's also other sources of reports that come to our attention. And we use data from Metals Focus that highlights that central bank buying has been outpacing some of the reports from the IMF. And that is not uncommon, even though in this chart that only goes to 2016, you see that generally those two trends are very similar. If you extend this chart further, you would see that there have been periods where central banks just take a little bit longer to disclose or report their sales. Or sometimes it is not only central banks, but other official institutions, maybe sovereign wealth funds or other parts of the government that are including gold in their reserves, and therefore we capture this broader trend in official institutions, which includes central bank buying. Now, let's move on and as to the why. Why do central banks buy gold? If you remember from the chart that I mentioned earlier, central banks have been buying gold for more than a decade. And this is not a coincidence. After the gold standard collapsed and Bretton Woods collapsed in the 1970s, many European central banks and Western central banks had a lot of gold in their reserves, and they started to sell some of that gold. Eventually, they reached a level where they were no longer interested in selling any more gold, so they have held to their reserves. And at the same time, following the Asian financial crisis in the late 90s, emerging market central banks started to increase their reserves for gold. Naturally, they were trying to diversify away from, for example, the dollar, because there was a lot of reserves primarily in emerging markets in dollar terms. And they have been diversifying some of those reserves, some of which have made their way to gold. Now, again, if we look at in particular the portfolio aspect of foreign reserve management, we see that there are three main reasons why central banks hold gold. The first one is safety. Gold is seen and is used as a safe asset, and I'll talk about it in a minute. Liquidity. The gold market is also very liquid, which allows a central bank to enter the market without creating distortions. And then the third one is that also gold has been performing quite well and providing some return. Even though that's not the main objective of foreign reserves, it is useful when an asset performs like that. So let's look at the details of these. So safety. Mr. Ding earlier also mentioned that generally developed market currencies haven't seen a default in recent times, but and while this is certainly true, historically that has happened. And not only that, central banks do not necessarily hold currency directly. They sometimes hold, well, most of the times they hold sovereign bonds. So Greece, for example, defaulted in 2012, and that created an issue for those holders. Even if the euro was okay, right? Anyone who was holding Greek bonds would have had an effect. So opposite to bonds, gold is an asset. It doesn't have any credit risk. And that is attractive to central banks, even though it doesn't look like some of the other assets they hold, which is primarily bonds, right? It still has qualities that are useful, partly because of that hard nature as an asset, as a hard asset. It is also true that gold tends to perform quite well in periods of risk. So when we see recessions or when there's a lot of uncertainty in financial markets, we tend to see gold to perform well, and that can help reserve managers mitigate some of the risk. as I was saying earlier, gold is also very liquid. In fact, when we look at gold traded in a given day, it trades about $150 billion a day, and that's a significant figure. And that is actually comparable to primary trading by T-bills by various banks on T-bills, right? And T-bills, U.S. Treasury bills, are some of the most liquid assets. And if you compare again, primary trading on those, that's more or less equivalent to what you get in gold. Why is that relevant? Well, it is relevant because it allows, as I was saying earlier, for central banks to buy gold without creating distortions, which they generally don't want to do. So they don't want to enter markets where there's not a lot of liquidity, because significant buying there can create distortions. And then finally, as you can see from this chart, since the 1970s, when the gold standard ended, gold has performed quite well. Its compounded annual growth rate has been above 7%, which is not too dissimilar to kind of like somewhere between global stocks ex-US and US stocks. So again, even though it is true that gold does not produce a coupon because it's an asset, it's not a liability, so it's not producing that coupon, it has tended to produce very strong returns. And this is, even though this goes back to the 1970s, even if you look at the past 20 years or the past 10 years, again, gold has performed quite well. And even though it is not the most important objective for foreign reserve managers, it is also something worth noting and something they themselves note. Now, let's move on to our central bank survey. As I mentioned, we conduct a survey once a year. This is going to be, this was the fifth consecutive year of our central bank survey, and we get responses from all over the world. There's a slight change or a slight typo on the label over there. We got about 22% respondents from developed markets and about 78% respondents from emerging markets all around the world, right? And this is more or less representative of the universe of central banks, which basically means that the answers can be quite useful because they are indeed, even though not all the central banks report, the ones that are reporting more or less represent appropriately what central banks overall think. Now, on average, those respondents, how does their foreign reserves is usually comprised? Well, about 51% or so is in dollars, 17% is in euro-denominated debt, and then we have gold, which is on average about 15%, and for example, Chinese renminbi is about 2%, and we'll see some figures about that as well, which can complement some of the remarks that we heard from Mr. Ding earlier today. I think that one of the really important takeaways from the survey is that when we ask central banks what they thought about the level of gold in foreign reserves across central banks, 7 out of 10, so 70% of them, thought that gold reserves will increase over the next year, which is not surprising given that the trend has been following that direction. So it's common, for people to assume that things will follow suit. But it is really interesting to see that, generally speaking, central banks do see gold reserves increasing over, the medium term, but also over the long run. Now, taking a step back, what are the things that central banks look at to decide how to manage their reserves? Not just their gold reserves, but all the reserves. Well, they look at the level of interest rates. They also think about inflation and what that does. They also think about geopolitics, not surprisingly. Interestingly enough, for developed markets, ESG is becoming also an increasing issue, which matches more or less the trends that we are seeing by investors. And then finally, there's a combination of other factors, but we can see that those first 4 are some of the most important in general for foreign reserves. Now, let's look at what central banks think will happen to their gold reserves. And what we can see there is that, generally speaking, central banks are expecting their dollar reserves to come down a little bit. So even though developed markets, in particular, are thinking that the majority, 54%, are going to stay where they are, you don't see the same trend by emerging markets and even some developed markets that are still thinking that overall dollar reserves are going to come down. But if dollar reserves are coming down, what are they doing to basically replace or substitute some of those reserves? Well, not surprisingly, some of that may come in the form of renminbi-denominated debt. So you can see that actually over the next 5 years, central banks expect renminbi reserves almost to double. If you remember from one of the slides that I mentioned earlier, the average composition of this particular crowd was about 2% in renminbi terms. So they are expecting that to go to somewhere between 3 and 5% over the next 5 years as a majority, with some even outliers increasing more than that, right? Which is not too dissimilar to what we heard before. And also, they expect gold reserves to increase. So developed markets are not necessarily thinking that they will increase their gold reserves a lot, and that is not surprising because they still hold a lot of gold in the reserves. So for example, the US has more than 70% of the reserves in gold. Germany also has a really large percentage in gold. So they do not necessarily need to increase as much. But it is not surprising to see that emerging markets on the other side and developing markets will likely increase their gold reserves. Now, in particular, when we look at gold and what are the reasons why investors or central banks hold gold, well, for developed markets, which is the bright green bar on the left-hand side, most of them hold it as a historical position. It is an asset that they value and they find value in, but they have held it for a really long time, so they are looking to keep it. But when you look at emerging markets, which is the source of growth for gold reserves, well, they are looking at the performance of gold in times of risk, which is, again, not surprising. Also the fact that gold is a long store of wealth and it hedges inflation, global inflation, not just US CPI, but more generally the depreciation of currencies around the world. They also see it as a very effective portfolio diversifier, right? And that's something that we have also seen in the data. The data supports that fact that gold can diversify returns and portfolios. Whether your portfolio includes only bonds, like central banks, or is a more well-diversified portfolio, like the ones that most of you probably hold, which will include stocks and other alternative assets as well as bonds. You can also see that for emerging markets, gold being highly liquid is very, very important, right? And then finally, another thing to highlight is that for emerging markets, gold as being a geopolitical diversifier is important because gold is no one's official currency, but it still functions as one, right? So you're not banking on the ability of a particular government to promise on their fulfilling their promises on currency, or just generally that they can potentially weaponize their own currencies. Again, gold stands apart, and it's not surprising to see that emerging markets tend to gravitate towards something like that. So you can see that there are quite a few reasons why this happens, but many of them are very consistent with what I mentioned before in terms of safety, diversification, liquidity, and a source of returns. Now, let me conclude by saying that overall, central bank and official institutional demand has more than doubled over the past couple of years. So if you look at the level prior to 2022 to what we reached to in 2022, that has significantly increased. And this year, we continue to see demand in a very, very strong way. it represents a material change, or it represented a material change in the market, a structural shift more than 10 years ago, and remains an important component for the gold market. In fact, if you may be aware that gold has been one of the best performing assets this year. So far this year, gold is up by more than 13% in dollar terms and significantly higher in renminbi terms, right? So it has been a very important performer this year. And part of that support has come from central bank demand. Not only that, but it's one of the contributors. Now, what is driving purchases from central banks into gold? Well, inflation, geopolitics, the fact that it's sanction resistant, and also because of this multipolarity. In other words, that the world is moving into an environment where the dollar may still remain a really important part of foreign trade and foreign reserves, but it's not going to be the only one. And an example is the growth that we are seeing in renminbi and renminbi-denominated assets held by foreign institutions. Now, we don't expect this to slow down or to stop. Even if we may not necessarily see the same level of demand that we saw over the past couple of years next year, we still see a positive trend, right? And that in itself is quite important. And this has allowed gold to perform well and provided additional support complementing the market, because you may remember hearing earlier today that gold has this dual nature, that is not just an investment, but it's also a consumer good, a luxury item. And in addition to that, it's an important component of foreign reserves. So there's this part of demand that is independent as well from both investors and consumers that can help grow the market. So with that, I'm going to stop, and I really appreciate you having me again here today. Thank you.
Thank you very much. 谢谢。